Okay, so the markets in North America are now open. Let's get another look at what's happening with equity activity in North America. We mentioned that initially the TSX was finding a little bit of buying strength, the S&P 500 as well. Those gains holding for now, but obviously still plenty of uncertainty in a week where we're not just watching banks that are viewed as being troubled, but also what exactly the U.S. Central Bank is going to be doing. Let's get some more insight and analysis now from one of our good friends of the program, Liz Miller. She's president of Summit Place Financial Advisors. Liz, it's nice to have you with us. We appreciate this time from you on a busy morning. But I guess one of the questions that everybody's asking, more broadly speaking, is, are we still in a banking crisis? Were we in a banking crisis? And have the actions taken so far taken that off the table? What would be your answer to that?
I think our answer is we still don't know. You know, this is so unique, and I just keep repeating it for anyone who's following this. This is not about bad assets. This is not about mortgages gone bad. This is not about anything worthless on these balance sheets. It's really a confluence of some unfortunate situations that a lot of investors can relate to. The banks own a lot of long-dated treasuries, long maturity bonds, which for our clients we consider to be really safe. And just like our clients, as interest rates went up, the value of these bonds have gone down. When our clients hold them to maturity, they're going to be just fine. The banks are getting pushed because people are putting in a lot of deposits and in some places taking deposits out, where the banks are just being forced to sell down and down and down just to build liquidity. And I think that that's a situation that a lot of investors don't understand, and that's why they have this deep concern about the stability of the system. It truly is a liquidity issue brought on by our own central bank here.
Really helpful context. It reminded me of a conversation I had with the noted economist Nouriel Roubini last week, where, to your point, he highlighted market risk as opposed to credit risk, which was at the center of the storm back in 2008. The market risk being that you have these long duration bonds that are underwater. In theory, you get out of water over the long term. But if you're pushed to sell, as, for example, Silicon Valley Bank was, that can look pretty messy. He's starting to argue, though, now that because of the uncertainty within the banking system, then the credit risk story starts to materialize, or I guess the other part of the risk story materializes along with market risk, so much so that he was advising people close to retirement to avoid long duration bonds, to look at short-term treasuries, to look at gold, to look at inflation-protected products as the place to be. And look, I know he's known as Dr. Doom, so he's been very cautious on the long term for a long time. But what would be your response in terms of portfolio positioning to that?
So our clients already own, a well-positioned bond portfolio for where they are in life. If I'm talking to clients approaching retirement, I don't want them to make a lot of changes. One of the nice things going on right now is the ability to buy higher coupon bonds that will throw off income in retirement. So you certainly should be adding those to the portfolio. But I don't want people avoiding investments that make sense over the long term for where they are in life. And if interest rates stay higher longer, which is certainly what we were all talking about just 2 weeks ago, that does change the portfolio for those approaching retirement and those in retirement. It does make the trade-off between a fixed income product and an equity product, a different discussion for each person's circumstances. But sitting here today, I think what we all are talking about really is, what is our central bank going to do in the face of a situation that arguably they kicked off, and do they have the wherewithal to provide the liquidity to bring full confidence back into the banking system?
Right. Okay, good context there. I want to just talk about the opportunities that perhaps one could see out there. I'll remind our audience that Bloomberg already reported that Warren Buffett's been talking to members of the Biden administration about what he possibly could bring to the table. And remember, this is somebody who sees long-term opportunity in financials, banks. Who knows if he's going to give a vote of confidence in the days ahead. But in terms of the kinds of areas where you might see some opportunity in the markets right now, Liz, so what would be some examples?
So in the financial area, one of the names we're talking about is State Street Bank. They're a very big player in the exchange-traded funds. They're the spider. I think I've mentioned it here before, but this is one that's been painted with the same broad brush of everything right now. There's lots of them in the banking industry that are probably good long-term buys right now. We're just highlighting that one at a particularly good valuation right now and a different kind of business mix that really we expect to be doing just fine as confidence comes back to our system.